Sanlam Private Investments held their quarterly briefing today. They shared their views on the financial markets. A little earlier today, I caught up with Alwyn, Merwe, Director of Investment, Sanlam Private Investments, to get his insights into whether the currently the market's volatility would be seen as an opportunity or perhaps a threat.
I'm certainly worried when we talk about the macro scenario, because we can't get away from the fact that in Europe, we probably in the hands of politicians at the moment to get us out of the problems, or to get at least a solution on the table. However, having said that, I think over time we will muddle through it, and the economies will get going again. On the balance of probabilities, we don't think the US will go into the so-called dreaded or fear double dip recession. The biggest risk probably sits in Europe. But then I think one must again just look a bit wider than those two big economic entities, and the rest of the world. If you look at China, for instance, the growth rate is still above 9% at the moment. So there are certainly some uncertainties. So in economic terms or in investment terms, we say the visibility is rather poor. However, I think the danger for investors are that they are being swayed and influenced by the macroeconomic views. And what we've seen is that investors have responded to the uncertainty in the macroeconomic environment, and as a result of that, asset prices have sold off significantly, particularly risky assets. So if you look at the valuations of equities across the globe, they've come down significantly, and I think there's some value to be had now.
With regards to the crisis that we're seeing now, and you've alluded to it as well, with regards to it being a crisis of confidence as opposed to a liquidity crunch and a liquidity crisis to what we saw in 2008, it seems that there's a lot of fear that has been priced in at this point, but earnings are coming up and they're looking strong. We're seeing the resource companies still offering so much value. Why are investors just not getting out of the fear slump that they're in? Is there just so much fear around, and a fear of possible default, that is just keeping people very cautious?
Exactly. As I said, I think there's a big difference between the current situation and the situation that we had in 2008. 2008 was a liquidity crisis. Now it's a confidence crisis, as you said. Although the earnings season that we're experiencing now, and even in the previous probably 7 quarters, earnings numbers were better in the States than what the market expected, commentators fear that a so-called expected double-dip recession in the States or a recession in Europe will actually put a halt to the decent earnings numbers that we've seen from companies. If you look at the equity market in particular, and South Africa in particular, the one area where there's a huge concern, of course, is within commodity shares, because commodity prices recovered strongly after 2008, 2009. But as the uncertainty grew in terms of the economic prospects for US and Europe, some of the commodity prices came under severe pressure. The iron ore price lost about 30% in the last 6 weeks. So people don't have a lot of conviction in terms of the earnings forecast going forward. So although the shares might look attractive on a forward basis, the fear is that analysts are too optimistic in terms of the earnings forecast, and that is why share prices are not responding to the value on the perceived earnings stream, but share prices are responding to the flows in the macroeconomic environment.
With regards to asset allocation, I know you're of the view to have around 60% in equities. You're looking at bonds, but corporate bonds as opposed to government bonds. Tell us about asset allocation right now, and is it becoming a tougher task?
I don't necessarily think it's a tougher task if you have a slightly longer term outlook, and that is what we try to get through to our clients. The valuation of asset classes is normally the most dominant factor driving our investment decision. So what we say to our clients is, depending on your risk profile, but that we want to move to a slightly overweight position in equities, because the valuation is quite compelling for us, particularly for international equity markets. Within bonds, as you've said, bonds for us, if you look at the actual yields for the long term, simply doesn't offer a solution if you want to grow your investments over time. If you compile a basket evenly weighted of US bonds, 1 year to 10 years, the average yield is about 0.9%. Now you can buy the Dow Jones index with a dividend yield of almost 2.8%. So it makes no sense to us to invest in that asset class with a longer term perspective. You get decent, better yields if you buy corporate bonds, and given the fact that the corporate's balance sheets are in much better position compared to 2-3 years ago, I think there's less risk there. And lastly, I think one should also consider property. It's also an asset class that's sold off, particularly internationally, and I think one should consider that as part of your portfolio, and probably somewhere between 5 or 10%.